Yeah, just looking at some of these loan maturities, breaking down per asset class, and we can see, as been reported many times here on the Gray Report, we got a lot of loan maturities coming due in this year, really starting to peak in October. So we're going to see movement a little bit before October. Some people are going to have to make some decisions before the actual date. But then we still have a lot in 24. In 25, significantly less. In 2023, we've got around 700 billion in loan maturities. Am I reading that correct, Matt?
Yeah, and another thing too, which is interesting about this chart, it does have a little bit of a breakdown of which of these which of these sectors have the most loan maturities at a given moment. So multifamily is a little under $200 billion in 2023, and it jumps to about 250 in 2024. Now the big chunk for this year is office. It seems like at a little bit more than the multifamily, probably close to 200, whereas multifamily is a slightly smaller slice this year.
And while multifamily, obviously, again, different fundamentals, we can't ignore that, a lot of the lenders, especially in like the bridge, debt fund space, on the private lending space, CMBS, there are a lot of the same investors and the same lenders. And so if credit is tightening, which is tightening for other reasons, less money for, what if they have a bunch of bad office loans, they're really going to be looking at some of their multifamily loans as well. It's going to be probably a bright spot in their portfolio. But again, that's where there may be opportunities. They may need to sell some of these loans. Yeah, there could be some opportunities there. The next, again, 23 through 24, with office really hitting us in a big way later this year. But then, maturities, it really trickles out, which makes sense because a lot of loans are relatively shorter term. Mm-hmm. So it's, there's going to be new loans originated. Yeah. But you've also seen there's going to be a gap of maturities for a period, a year to 2 years from now, because no one was doing deals. No one's been doing deals the last 9 months.
Yeah, and that's another, and that's something that
certainly not nearly as many bridge loans.
Yeah,
also,
and I think that's going to affect supply as well too. It's funny to see the share of office shrink to virtually nothing in 2027.
Yeah, well, that's because so many of them are just short-term maturities.
Yeah.
So just really quick going through some of this, Matt. Quarterly volume in terms of, are these loan origination volume or purchases?
I'm pretty sure that these are sales volumes.
So 25.4 billion. We're down 25.4 billion. That's a drop of 10% year over year in terms of price changing in terms of multifamily. So it's interesting. Now, cap rates, they're saying they have converged in terms of garden style and mid-high rise, kind of sort of urban and suburban, which is really interesting because we had a pretty wide gap between urban, suburban, garden, high rise for quite some time. And then, through the pandemic, especially in 2022, they really narrowed, which makes sense, as we've been talking about. The downtowns, CBDs have been weak, suburbs have been strong. Mm-hmm. I'd much rather have a suburban property than a downtown property. And we've actually seen maybe even like a crossing of where suburban properties may be trading at a premium, which is really interesting. If you think about it, especially, the mid and high rise properties, you're usually getting better square footage, take as much acreage. But it's interesting. And for both, they have cap rates, well above 5%, kind of coming in, right at, 5.15 or something like that, or, maybe, getting close to 5.25. National average, I think that's makes some sense with just the limited amount of pricing in market transactions that have occurred, and those that have occurred have mostly been, 1031 transactions where someone has been willing to kind of meet that strike price of that seller, or at least get close enough. So still relatively low cap rates relative to interest rates. That's where what we're going to continue to wait and see is as that 1031 money dries up. Because right now there's only a handful of deals that are coming on the market, handful of buyers that, have a big tax bill and they'd rather not pay the taxes, they'll take a lower return. But they'll get a point where there will be more properties coming on the market than there are 1031 buyers. And there's not going to be any more time to wait. A decision is going to have to be made. And that's where we could see some of the prices start to really decline, especially in the office market. I mean, decisions are going to have to be made. What are buyers going to do with these properties? They're either going to be handing them over to the bank, or selling them at just an incredible discount. And again, the entrepreneur in me is like, well, let's go buy some office buildings, but what are you going to do with them? I think you're right, Matt. Maybe data centers.
Yeah.
Let's figure that one out.
All right.
I don't know. I mean, or I'm like, do we buy a downtown skyscraper, move our offices to the top couple floors, and then just, room for activities below, and wait until the market turns around? I mean, like, there is a price where that works.
Yeah.
Like, it's low. It's very, very low, but like there's a price.
Space
entertainment venues. I don't know.
They're still not making more space, and but what they are making, all this knowledge work, all this information work, it's getting cheaper and cheaper. And physical space, it's cheap now, but it may not be quite so cheap in the future.
Yeah, exactly. I mean, and something when we get into the whole AI discussion and deflation and the effects of pricing and the economy and how that all affects real assets. I think, and you've mentioned that a couple of times in the last few reports, Matt, of technology still hasn't really created a new solution for a lot of real things that happen, like housing. We're not all in the matrix yet, like in a pod.
Yeah.
Like there, maybe one day, but not.
Things are happening in the real world.
Not
still.
Not over the time horizons of our investment and our business plans today. Matt, what else do you want to talk? I mean, we touched on office. They have a piece on office. We've kind of hit it over the head. Anything else you want to mention on this report? We've talked about retail.
Yeah, retail, office, and we just as a broad characterization, it is interesting to think about the situation that multifamily is in, and it wasn't in this report, but I was reading something this past week, and just kind of in the jumble of me gathering all this research, where it's multifamily has one of the sharpest price mismatches of the sectors of real estate. And all of these office buildings, people know, people kind of have a good idea where the office is at. It's not in a good place, but at least there's a direction there.
Yeah.
There's a bigger question mark for multifamily, considering, some places are getting a lot of supply coming online.
Yeah.
We don't know what the debt situation, how that's going to shake out. The fundamentals are still good, but the expenses are up. There's a lot of things that are in the air. Things are in the offing. Things are coming, but it's hard to get like an exact price, and that's why it's just so frothy. And I'm at a loss to know like what's going to hit first, and if there's going to be a slide, if it's just going to be this like staggered amount of opportunities, or if there's going to be a fundamental price change that happens, as we enter.
Yeah, because I've heard from a lot of syndicators, and I don't know if it's just we're raising money, and so we've got to have just all positivity all the time. But I've heard a lot of folks say of like, no, there's not going to be a price dip in multifamily. Like, let's just buy now and just keep going.
My gut says, almost like my pessimistic gut says, like, no, you're not going to get an opportunity. Everyone loves it.
Yeah, exactly. And so we're here. It's a great business. Like, we're here, right? We see all this data, but you could have painted similar pictures back in the pandemic and no price drop really occurred, which means you have to be ready and on the data every single week and see where things are going.
Mm-hmm.
Because the one thing we do know, Matt, is we don't know where prices are going to go. Like, so we have to separate the investment case from the investor demand and like the underlying fundamentals of the business and the rental demand. And there's obviously a big correlation between the two. Yeah. Typically, when investor demand, the underlying thesis for like that thesis makes a lot of sense. There's obviously a lot of demand to invest in it. However, the mismatch is because of financing. It's a great business plan, but still the numbers don't make sense because the loans and where it's priced at. And real estate's a cash flow business, and so we got to get our cash flow. But we know that if interest rates do more normalizing than they have today, the value of those assets, really spikes back up in the near term. And I'm not like, it's not like many years down the road, it's like in the near future. But like today, if things have to be sold, the fundamentals say the prices need to be down here. And so who's willing to, make that top bid? Who's willing to speculate and go with lower cash flow for a few couple of years versus, folks like us that are saying, I want to buy on actuals, and like, the price I want to pay today is going to throw off good cash flow today, because I'm confident on the growth going forward, but I don't want to have to rely on that growth. I would rather that growth be like upside icing on the cake in buying for like in-place cash flow, something that I know is going to work, stress testing it. And that's good. Like, that's easier said than done. And I've seen a lot. We've been talking about not using negative leverage for the last year, Matt.
Yep.
And that makes doing deals really tough. But we've done it. We've done it on 4 deals in the last year or so. Yeah, last year we've done it on 4 deals in this environment. Not a single deal negatively levered.
Yeah.
But then I hear other folks, other syndicators out there, other promoters basically saying, and I don't know if it was they heard us talking about not doing negative leverage, or basically saying like why we would do a deal with negative leverage. And it does make a lot of sense. It's very nuanced. It's more aggressive, but it's not wrong. It's just a different approach and a different risk profile.
Yeah,
that is leaning more into speculation and assumptions than actuals. And because, so like, let's say you're doing a value add, the rents are way below market. Let's say they're $600. Like, you could do nothing and you can move them to $800. So you're going to buy that and the cap rate's going to look really low, but you're like, I know I can move it to $200. Once I do that, I'm going to have great cash flow. That makes sense. But going from point A to point B is not you close on the deal and you flip a knob and the rent goes up $200 and cash flow goes up. It's a long process.
Yeah.
It is a process. How long it takes is a variable. And again, how you financing it and how you're projecting things. Sure. Like, so you could buy a deal and say, and we can get cash flow up over the next couple of years, but what if it takes more than a year? What if it's 2 years? What if it's 3 years? What if something else goes wrong? Not saying that it will, but just, stuff happens. And it takes a while to season a property. And there's more potential for missing expectations, I guess I would say. And so it's like a lot of sophisticated groups do that. That's what Blackstone does. They'll like, hey, if we don't care about, negative leverage, what the cap rate is, got so much money to place, like we're focused on, and it's truly the difference on investors focused on total return, or more of a preference for total return, and focus for income, or a balanced approach of where, look, cash flow is the lifeblood of this deal. I want to see a lot of like real cash flow, not pro forma cash flow at stabilization, maybe 2, 3, 4 years, and I don't know.
What you seem to be outlining is an outlook that I think is going to be crucial for the mental health of apartment investors over this hump of whatever distress comes, because what the projections are and what's happening right now is the values of apartment buildings are going down, but the income's not, so ignore those values, because if the income's going to be fine, then that will jump back, because it's a product of the interest rate market and the investment market and all of that kind of things that aren't necessarily related to fundamentals. But you have to be kind of disciplined.
Yeah, you need to be disciplined. And I don't say you ignore the values, but they're not that on a deal that has fixed rate debt with some term on it, they aren't necessarily that important like today. Like you should have a good idea of where the value is. Yeah. But like what matters is how much cash is it throwing off. But you want to know what the values are, because that's how you can find some opportunities.
Yeah, well, and if we're talking about our own like reticence and distaste for negative leverage.
If you're not going to sell for 5 years or 10 years, what the price is today versus has nothing to do on the total return of the asset. It only matters when, really capital event happens, and so if values are today versus where they are next year and 5 years from now, it matters when you refinance, or it matters when you sell.
Yeah.
And you transact. It always matters, but it doesn't really affect total return.
Yeah.
And you could say, you want to be careful of not putting your head in the sand and being like, no, the value hasn't moved. It's worth exactly what I paid for it. Because that's just not reality. But does it matter? Like, because it's not being traded on every day. That's, I think, up to debate. And that's the great thing about real estate. It's like we have deals that it's worth less this year than it was last year. Other deals that are worth way more. especially as we bought them a couple of years ago. So they're worth way more still today. Even deals we bought last year, since we boosted NOI, they're worth more. But like, we're not selling next year. So, and it always takes, in my experience of doing this, thousands of units, it takes 1 to 3 years to like fully season a property. You can do a lot in a year, you can do a lot in 6 months, but it really, in my experience, it takes 3 years.
Yeah.
So the first couple of years, while they're incredibly important and time is money, not unless I look at value every month, maybe every quarter.
Yeah. Well, and that's what I mean. It's like, if you're eyeing an exit, whether it's demand for your investors, or you see, that this is your path, and so your strategy from the beginning, then great, look at the value. But what I'm saying is that we could be in a situation where NOI is going up and valuations are going down.
Oh yeah, exactly. They are.
And like, that's important if you're going to exit. But otherwise, like, if you have a long enough horizon, you could look at buying opportunities instead.
Yeah, exactly. And that's what we're doing right now.
Yeah.
It's like, all of our deals are set up for the long term. We don't have to do anything right now. So we're setting that aside, being smart on asset management and keeping moving forward and fine tuning and reducing expenses. But it leaves us now open to say there's going to be some potential great opportunities.
Yeah.
And if there's not, that means all the rest of our portfolio is still worth more than what we thought it could be.
Yeah. Yeah.
Again, does that really matter if we're not selling this year? No, but that may mean that we have refinance opportunities next year that we aren't thinking about right now. And so if you have different durations, if you have long-term holds, you have so many opportunities if you set them up the deals the right way to, refinance instead of sell, pull some cash out. I mean, we're doing a property right now that we've owned now going on 6 years. 5-6 years. We're looking at refinance. It'll be the second time we've refinanced it, and the second time we've pulled more than 100% of capital out tax-free.
That's nice.
Yeah.
That's nice.
130% the first time. We're going to do this next one is going to be almost like 150, 170%. So everyone's gotten their money back. It'll be while we still own the deal, it'll be over a 2x. It'll be like a 2.4x, but we still own the property. That means we can refinance it another couple of years again when rates are actually even lower. Or we can sell it at some point, but like right now it's throwing out so much cash. Why would we sell it?
Yeah.
We could just continue to pull cash out of it. So like, if you have that long-term horizon and you've structured it that way, you have so many more opportunities.
Yeah.
If the prices like skyrocket, you can still refinance and sell. There may be a prepayment penalty, but again, that's like the insurance that you're paying, for that long-term horizon.
Yeah.
And sometimes that prevents you from taking action, but if the gap is wide enough, you can usually make sense of it.
Yeah.
Or you can get a supplemental on your loan and don't have to pay the prepayment penalty. There's a lot of options. That's why multifamily is great, and it's a good position to be in unless you had a short-term approach, an aggressive approach.
Yeah.
And you bought with negative leverage because you were like, well, we're doing a value add plan. We're just going to grow out of it. And then you don't get your premiums and your expenses go up.
Yeah.
And you did a bridge loan because you're going to do a value add. And, then you're still negatively levered. You haven't grown yourself out of it. So like, it's not a put a bookend on the negative leverage.
Yeah.
But it's not bad. It's not a wrong strategy. It's very sophisticated. It's what some of the best, largest firms in the world do. It's just a different risk profile than going off of actuals.
Yeah.